Good morning. As we look at the market before the opening bell on Tuesday, October 28, 2025, we are tracking Nuburu, trading under the ticker BURU. The U.S. markets are currently closed. Nuburu finished yesterday's session on October 27th at 39.5 cents per share, down about 1.25% on the day. Yesterday's volume was just under 550,000 shares, and the stock traded in a range between a low of 36 cents and a high of just under 44 cents. Now, seeing a sub-40-cent stock, the immediate assumption is that this is just another forgotten microcap, another casualty of the SPAC boom, bleeding out towards zero. That's the expectation. But the reality of what is happening inside this company right now is one of the most aggressive and complex strategic pivots you will find on the entire exchange. This isn't just a laser company struggling. This is an attempt at a complete corporate rebirth, a frantic shift from industrial tech into defense and security roll-up. Most people who remember Nuburu at all, perhaps those who saw it on their Robinhood app or SoFi Invest platform a year or two ago, think of it as the Blue Laser Company. That was the story. They had this unique technology for high-power blue lasers, which are supposedly much better at welding conductive metals like copper than traditional infrared lasers. The expectation was that this would be a critical supplier for the electric vehicle industry, for battery manufacturing, for welding copper hairpins in motors. It was an ancillary play on the entire EV boom, a boom that sent names like Tesla stock into the stratosphere. Investors expected Nuburu to find its niche, sign big contracts with automotive suppliers or consumer electronics firms, and slowly build a high-margin hardware business. That was the story. It was a simple, clean, high-growth tech narrative. The reality, however, is that this original business model appears to have failed to gain sufficient traction. A look at the company's financials for mid-2025 tells a story of extreme financial distress. As of June 30th, 2025, Nuburu had just over $111,000 in cash and short-term investments. That is not a typo. $111,000. Against that, it had over $47 million in total liabilities and only $2.4 million in total assets, leaving it with a staggering negative total equity of over $44 million. The company was, for all practical purposes, insolvent. The Blue Laser story, whatever its technical merits, was not paying the bills. This is the kind of balance sheet that gets a company delisted, a far cry from the fortress balance sheets of an Apple stock or the consistent cash generation of Nvidia stock. This kind of investment is not what you'd find in Schwab Intelligent Portfolios or most Fidelity mutual funds. This is the definition of high-stakes speculation. So, facing annihilation, the company initiated what it calls a transformation plan. And this is where the story gets incredibly complex. Forget the blue lasers, that's the legacy business. The new Nuburu is a holding company for defense and security acquisitions. In the last few months, we have seen a dizzying flurry of press releases that outline this new direction. In September, the company managed to close a $12 million public offering. This wasn't for R&D on lasers. This was a lifeline, a war chest to fund the new strategy. With that cash, Nuburu has gone shopping. The first and most significant target is an Italian company called Tecne SPA. Nuburu is in the process of acquiring a controlling interest. Why Tecne? Because according to Nuburu's press releases, Tecne has an existing portfolio of orders valued at approximately $500 million in the defense sector. This is the bull case. The expectation Nuburu is trying to sell is that it's buying $500 million in revenue for pennies on the dollar, instantly transforming its financial profile. The reality is that these are portfolios of orders, not guaranteed revenue, and the integration of a foreign defense contractor into a struggling U.S. microcap is fraught with execution risk. But this move single-handedly shifts the narrative from struggling laser maker to emerging electronic warfare and defense player. Just a few weeks ago, on October 7th, Nuburu announced another binding agreement, this time to acquire Orbit SRL, another Italian firm. This one is a software as a service, or SaaS, company specializing in operational resilience and crisis management. This is meant to be the high-margin, scalable software component of their new defense and security hub. This sounds compelling, right? A hybrid hardware and software model. But here is the reality that requires serious attention from anyone doing their self-investing. In the 8K filing associated with the deal, it was disclosed that Orbit SRL is wholly owned by Mr. Alessandro Zamboni. Who is he? He is Nuburu's own executive chairman and, as of October 1st, its new co-CEO. This is a related party transaction. The company is using its scarce capital raised from public shareholders, to buy an asset from its own new chief executive. The deal terms involve millions in cash and preferred stock. This is a massive red flag for corporate governance. It creates an immediate tension. Is this acquisition genuinely the best use of shareholder capital, or is it a way to enrich an insider? Then, just last week, on October 22nd, another announcement. Nuburu, through its new subsidiary, Nuburu Defense LLC, is forming a joint venture with Maddox Defense. The goal? To develop and deploy advanced drone technologies targeting what they estimate is a $7 to $10 billion annual NATO UAV defense market. They're projecting this JV could reach $100 million in annual revenue by 2028. This is another layer of speculative potential piled on top of the Techne and Orbit acquisitions. The stock, naturally, spiked on this news. This brings us to the stock chart and the trading behavior. When you're managing your individual brokerage account, whether it's through Fidelity, SoFi, or Interactive Brokers, and you pull up the BURU stock chart, you see extreme volatility. This isn't online investing in the traditional sense, it's a trading vehicle. In early October, the stock went on a tear, running up 106% in just 6 days on this flurry of news. This is classic press release-driven momentum. But look deeper. The short interest in Nuburu is astronomical. As of the last report, over 26% of the stock's entire float is sold short. That is an enormous bet by the market that this transformation plan will fail. The daily off-exchange short volume ratio is consistently over 50%, meaning more than half of all trading volume on many days is short selling. This creates a powder keg. The bulls, who believe in the Techne $500 million order book, are in a direct war with the bears, who see the negative equity, the desperate pivot, and the glaring related party acquisition of Orbit. This stock is not moving on fundamentals. It's moving on the day-to-day battle between short squeeze hunters and fundamental-based short sellers. Anyone engaging in Robinhood stock trading with this name is playing with fire. So let's step back and talk about what the company used to be, just that we have the full context. The original Nuburu, founded in 2015, was a pioneer in industrial blue laser technology. The physics is sound. Blue light has a shorter wavelength than infrared, and it is absorbed far more efficiently by metals like copper and aluminum, which tend to reflect infrared light. This means you can weld these yellow metals with less power, less spatter, and higher quality. The applications were clear: EV battery manufacturing, welding cell tabs and bus bars, consumer electronics for soldering microcomponents, and even 3D metal printing. The expectation was that as the world electrified, Nuburu's technology would become the industry standard. But the reality is that penetrating these industrial markets is incredibly difficult. Supply chains are locked in. Big manufacturers are slow to adopt new processes unless the cost-benefit is overwhelming. And Nuburu was likely burning through cash far faster than it could sign contracts. The financial statements we discussed prove this. The original business model, while technically impressive, was commercially unviable, at least at the pace Nuburu needed to survive as a public company. The pivot to defense wasn't a choice, it was a necessity. They had to find a new story to tell investors to raise the cash they needed to avoid bankruptcy and delisting from the NYSE American. The Fidelity brokerage platform and other investing sites are littered with the ghosts of such companies. So this brings us to the future outlook. What happens now? The expectation, as crafted by the company's new leadership and their constant stream of news, is that Nuburu 2.0 will emerge, a company with a legacy blue laser unit, which they say they will revitalize for defense applications, a major defense hardware business, Techne, a high-margin SaaS platform, Orbit, and a speculative drone JV, Maddox. They are trying to build a miniature defense conglomerate. They have filed a $100 million shelf registration with the SEC, signaling that they plan to raise significantly more capital to fund this vision. The reality is that this is one of the highest risk propositions on the market. The number one risk is dilution. That $100